Good afternoon, everyone. On behalf of OBMED and my team, I want to welcome all of our shareholders to our Spring 2026 call on the Worldwide Healthcare Trust. And as usual, I'm going to split the speaking with Trevor Polischuk. I will start out with the fiscal year results, the performance, the attribution. Trevor will take it over and talks about some of the key events happened during the fiscal year and some of the key catalysts going forward. And then I will take it over again on the portfolio part, how we structure the portfolio, and importantly on the investment outlook. And then we switch over to the Q&A session. So if we look here by the numbers for fiscal year 2025, so really the key highlights here, we had a 10% absolute return, but we had very, very significant excess return. So our benchmark, the MSCI Worldwide Healthcare Index, had only a pretty modest year, only up 1.8%, and we significantly, I think, beat the return of our benchmark, and we're very proud of that. One of the key highlights, and we're going to talk a lot in this presentation about M&A. This is one of the big, important secular themes inside our sector, and it was a huge driver for investment return here. Here I highlight the M&A basket. 560 basis points was the top performer of the portfolio, and this has been a really, really successful, important part of the Worldwide Healthcare Trust strategy for the past few years. And then very, very importantly, we had a record NAV set in November, so that's always great to see. And hopefully, once some of the volatility in the market abates, we're going to get close and exceed our record high NAV. And then importantly as well, we're very proud of our long-term investment track record of 13.3%, and this is now going in its 31st year. Now, if we look at the fiscal year here, you see this, the top line is the performance of the NAV of the Worldwide Healthcare Trust. The bottom line, the light gray line, is the MSCI healthcare sector. And you see here the fiscal year is really bracketed by two big macro events. You had obviously the start of the fiscal year, which was not easy, with the Liberation Day or the tariffs announcement here in the United States created quite a bit of volatility in the market. And then as we started the conflict with Iran, I think the markets got very, very volatile again. And those were the two big macro events, which were weighing on the fiscal year. But then you see the period in between those two events, when fundamentals mattered, like, for example, the Trump-Pfizer drug pricing deal, which is the red star there. And when actually there was an environment where we had lower interest rates, the Fed cut interest rates several times in the fall months. This very conducive environment for biotechnology. And this was really during this period when fundamentals mattered. This is when the strategy really shined. We generated a lot of excess return powered by M&A, powered by biotechnology. And then I think some of the excess return narrowed again a little bit when macro fears really overhung the sector. And there was a little bit of flight to safety in our sector, and some of the volatile names, the smaller cap, mid-tech biotechnology companies sold off again. But nevertheless, I think it's a strong fiscal year performance, on the trust with this plus 10% and a huge excess return of 8.2%. And if we look at the contribution, really what drove the performance, number one, biotechnology and M&A. You see here biotechnology plus 7.8%, 780 basis points of performance. Included in that number is actually 3 M&A names as well. So 3 names which we held outright, not through the basket, which got taken out. Then the M&A basket, 560 basis points. big cap pharmaceutical stocks were very positive, 430 basis points. Some good performance here in emerging markets and life science tools, and the really negative performance during the fiscal years coming out of Japan, a little bit from the unquoted. Healthcare services had a really tough period, especially the big US-based HMOs. They had a very tough period, so we had a bigger position in United Healthcare, and that drove it. And then medical technology. And medical technology, so these are the medtech numbers. They have been actually for the past 3 or 4 years really the highlight of the portfolio, but they had an off year last year, so there was negative attribution coming for us from the portfolio here out of the medtech space. If we look at individual names, I mentioned already we had a lot of biotechnology names, but it's really interesting. It was quite diverse, when you look at the biggest winners of the year. So you had a couple of big cap, large cap pharma stocks, quite a number of biotechnology stocks, Natera, a diagnostics company, and then a specialty pharmaceutical company, UCB in Europe. The three names with the green borders, those are the M&A names. So Apellis was actually bought by Biogen on the last day of the fiscal year. So this was a welcome shot in the arm at the very, very last day of the year. So Apellis had a positive 164 basis points. Avidity, a takeout of a biotechnology company in the fall, positive 147 basis points. And then Exact Sciences got taken over by Abbott. So that was positive 147 basis points. On the big cap pharma stocks, AstraZeneca was the number one, 228 basis points, followed by Eli Lilly. Those were our two core names in the portfolio, and then UCB close to 100 basis points. And then, on the negative side, there were really only two big detractors, but they were quite significant. Now, United Healthcare, that cost us 340 basis points. Here we, unfortunately, we actually started the last year on the right footing where we had almost no exposure to the big HMOs, but they made a big leg down, and unfortunately we bought them too early. United Healthcare, then our position, and it cost us 340 basis points, which was in line with the benchmark loss in the name. But the biggest distractor for the year is Boston Scientific. This cost, they had a little bit of slowdown on the quarter. Their growth rate came down a bit. They made a misstep here on the fourth quarter and the first quarter results. We had sold some of our Boston Scientific exposure last summer into the fall, but still it was a very, very large holding. And this was the biggest loser here with 421 basis points of loss on the year. Now, if we go into the start of this fiscal year, with the macro overhang in Iran persisting, overall healthcare had a tough start to the fiscal year, so minus 3.45%. The fund went down only 1.1%. So we have good excess return over our benchmark of 2.4% to start the fiscal year 26. So now coming to the next slide, this is our performance for 3 years. The big for our 3-year attribution, we are beating the MSCI Healthcare. So MSCI Health was over the 3-year period up 9.1%. The fund is up 10.5%. So we do have an excess return of 1.4% for the 3-month period. During this period, actually, the big positive names are Eli Lilly, Intuitive Surgical, Natera, Tenet Healthcare, a hospital company. MedTech in general was really very, very positive over the 3-year periods, even with the significant shortfall here, what we have seen in the last fiscal year. And you see the big loser for our last fiscal year of Boston Scientific with over 400 basis points of performance loss last year. But for 3 years, Boston Scientific is actually a winner. We gained probably 100 basis points on it. So this has been a huge winner for us over the 3-year period. And here, the losers for the 3-year period is really only one large cap biotech stock by Biogen, and then United Healthcare on the HMO side. Taking a little bit a longer point of view, on our 30-year plus performance, I think we're quite notable. We had a record high NAV on the 16th of November. Then, unfortunately, the Iran conflict started, pulled back a little bit here on the performance. But we are very, very optimistic that we will continue, I think, our long-term trend, really outsized performance of the fund vis-a-vis its benchmark and the broader market averages. And we're obviously very proud of this long-term track record. And if you look at the competition comparative performance for all the funds which have been in existence at the time when this fund was started in 1995, we are the number 2 performing closed-end trust in the UK. So I think it's a very, very solid performance for such a really long period. And with that, I hand it over to Trevor.
Great. Well, thank you, Sven. I would like to start and give you a little bit more detail on what really mattered in 2025. And Sven has mentioned a couple of those things, but we just wanted to go into a little bit more detail. And, perhaps the largest catalyst, not only last year in healthcare, but probably over the last 10 years, is that drug price reform in the US has finally happened. And this was last September 30th to be exact. Pfizer unexpectedly signed a landmark agreement with the current administration here in the US that not only spared the company from tariffs, but created some real stability and certainty finally in the domestic drug pricing market that will not only increase some affordability for patients here in the US, but also protect innovation going forward. And now all 17 companies who received Trump's letter, which outlined his demands, have signed similar, if not basically identical deals to Pfizer since that September date. And let me briefly detail what Trump got and what it means for industry, because I think it's critically important going forward. First of all, the administration created this new low-cost direct-to-patient pharmacy called TrumpRx.gov. And this is a new sales channel for the industry, and an incremental positive, because this is an incremental sales that probably didn't exist much before. And you can see in this example here with the Zepbound vial, with a 72% off discount. It's a dramatic saving for patients, but probably incremental positive sales for the industry. Most favored nation also got adopted, and Medicaid. But recall, Medicaid is already the lowest price and lowest volume channel for the industry. So there's a very modest impact here. MFN was also adopted for Medicare. But this is only for newly approved Medicare drugs. So no price changes for already marketed products. So the impact here, we think, can be managed quite easily going forward. And perhaps most importantly, in the commercial sales channel, no legislation here whatsoever. So no price changes. This is critical because this is the highest priced, highest volume sales channel for US drug companies. So zero impact here. And this is probably where the biggest fear was. Foreign policies switched a little bit. Newly launched drugs in developed countries cannot be priced lower than they are in the US. So foreign drug prices now are expected to rise going forward. And this is what we call basically a thesis bonus with this legislation. And finally, the industry has pledged across those 17 companies at least nearly $500 billion in manufacturing investment, R&D investment over the next 10 years. in exchange for zero tariffs from this Trump administration. And I think the positivity there speaks for itself. So at the end of the day, we really view this as a win-win situation that has removed a decade-long overhang from the sector. But most importantly, share prices have really reacted. When we look at this chart, starting from the bottom, we see the S&P from September 30th into the end of our fiscal year is roughly flat. Our benchmark here in gray has outperformed that significantly at 9.4%. Drug stocks have outperformed the benchmark at 17%. Perhaps most interestingly, that biotech stocks have inflected the most at 31% here in that green line. So this has been a tremendous catalyst for the whole industry, and especially biotech, and all of it is re-rated accordingly. And we expect this to continue going forward. And this is a significant reversal of what we've seen basically over the past 10 years. And investors who have been with us for that period of time will understand this chart. But this is a period in which healthcare stocks have dramatically underperformed the broad market, a period in which biotech has fared even worse. So I think with this current situation, with this massive overhang removed and valuations still low, fundamentals strong, the setup for a long-term reversion to the mean is very strong here. Another thing that mattered in 2025, as Sven mentioned, and is going to matter again in 2026, is biotech M&A. It was really a banner 12 months for M&A, a total of 51 deals for over $140 billion in sales volume, making one of the busiest 12-month periods on record for biotech M&A. And you can see the acceleration throughout the year. And as Sven articulated, we captured a lot of this in our proprietary M&A basket, which had an amazing return of 55.9% on the year. And with still $250 billion of legacy revenue facing generic or biosimilar competition through 2030, these large cap companies that have been doing the buying, they possess the motivation to continue this buying spree into 2026. And we expect this vehicle, our M&A basket, to continue to generate significant alpha in 26 and perhaps beyond. So let me pivot here just for a moment, take a step back, sort of look forward a little bit and discuss why invest in healthcare today. I mean, and the answer is really simple. There's more people, more demand, more innovation, more spend. Each part of healthcare is being impacted by artificial intelligence, but it's all conspiring, importantly, to create a very highly predictable, long-term, high-growth industry that is huge, representing roughly 10% of global GDP, which is expected to double into the next decade. So at the end of the day, we think the strong structural drivers for the healthcare industry are absolutely in place. And the Worldwide Healthcare Trust is really poised to capitalize on this growth as we focus on the entirety of the healthcare spectrum, from developed markets to emerging markets and everything in between. We have institutional expertise in pharmaceuticals and biotechnology, medical technology, tools and diagnostics, healthcare services, as I mentioned as well. We have investment professionals in key developed markets of the US, Europe, and Japan, but also emerging markets of China and India as well. So ultimately, we think the Worldwide Healthcare Trust is truly a one-stop shop for global healthcare investors who seek to invest in all subsectors, all geographies, all market caps. And some of the key hallmarks of the trust include an investment portfolio that is really 100% a collection of our best bottom-up ideas across all of these subsectors, with a complete and total focus on innovation that we believe leads to industry-leading growth, all in a fund that is very large, liquid, and very diversified. And quite frankly, managed by a veteran investment team with a long-term proven track record starting our 31st year of managing the trust. And again, I think we've created the quintessential one-stop shop for all of your healthcare needs. So let's turn now and let me talk a little bit about what's going to matter in 2026. And I would love to start with everyone's favorite topic, which is GLP-1s. But that's okay because that's also my favorite topic as well. And we remain absolutely bullish in this space, despite some volatility in the share prices of some of the names involved. Why is that? Well, the market is huge already, and it's getting bigger and better as we look forward. Sales of the two big molecules, which is semaglutide from Novo and tirzepatide from Eli Lilly, surpassed $20 billion just in the last quarter alone. We'll get updated numbers here in the coming days. But in 2026, we expect sales of these two molecules to eclipse $100 billion, a quadrupling of sales just over the past 3 years. So GLP-1 based therapies have already reached unprecedented scale, but we believe there's significant headroom remaining as indications expand. So specifically, what are we thinking about for 2026? Well, the orals have finally arrived. First in the form of the Wegovy pill from Novo, which has had an absolutely spectacular launch. I think exceeding even the most bullish expectations. And now, just recently, a couple weeks ago, Foundeo, which is the oral dosing regimen from Eli Lilly, just launched a couple of weeks ago. But we think these medicines will not cannibalize the injectables. Absolutely not. They're going to be mega blockbuster products on their own right, expanding this market. And we think sales of these products can reach 20 billion, if not perhaps more. Also for 2026, global expansion continues in earnest. We're going to go from just a handful of launches outside of the US to a whole basket full. And what has been really impressive in these markets so far, they've been basically 100% cash pay for weight loss. And the sales are already in the billions. We think that's going to shift. There will be reimbursement going forward, which is just going to increase utilization for what is already a very huge demand. Back in the US, the supply issues look to be a thing of the past. And now we're reaching 3 million prescriptions a week here in the US for GLP-1 based therapies. Really incredible number for a weekly basis. Label expansion will also continue to fuel growth. And I think this is the key going forward. I'm going to touch on that in the next few slides. But we're also on the precipice of many next generation therapies. From, again, Eli Lilly themselves and the very super hyped triple G, retatrutide. We're going to get additional data later this year, which is very exciting. We look forward to that. Novo's coming with their next generation combination product called CagriSema. The market's been a little bit underwhelmed with some of that data sets, but we'll have to wait and see. And there's so many other companies jumping into the pool. So much so that almost a third of our portfolio, intentionally or not, gives us some kind of exposure to the obesity theme, with names like Roche, AstraZeneca, also exposed, and of course Pfizer also exposed to the obesity theme. And one name in particular that I would call out is Structure Therapeutics. This is a small San Francisco-based biotech company, only a couple hundred employees. What's interesting about them is they might have the best oral therapy in development in the GLP-1 space. Yes, perhaps better than Lilly's, perhaps better than Novo's. But this is a smallish company. Market cap's only $3 billion. And I recall, I told you, these could be $20 billion plus drugs independently. So we think there's a bit of a mismatch there in the value of this company and what the potential is. And it also fits very well with our M&A theme. within the portfolio. So, regardless, I think the next phase of the obesity market expansion is already underway. And where does that growth come from? And here, the real secret to this category, it's not about the weight loss. Not that that's not important, but rather it's really the beneficial effect that these drugs have in so many other disease pathways in your body, that GLP-1s, when used alone or in combination with other medicines, can dramatically improve cardiovascular health and treat a number of metabolic diseases. And this slide details clinically proven data that demonstrates the risk of the reduced risk of cardiovascular death, reducing your risk of having a stroke, reducing the risk of having a heart attack, reduction in kidney disease, improvement in physical activity with patients with heart failure, reduction in sleep apnea, reduction in pain in patients with arthritis, reduction in liver disease. And look at this statistic on the bottom. Obese patients taking a GLP-1 therapy had a 94% reduction in the risk of developing type 2 diabetes. 94%. That's basically disease prevention right there. I think this is very exciting, and I think this is what drives utilization, reimbursement going forward. And it really doesn't stop there. There's emerging evidence, albeit some of it anecdotal, showing a multitude of health benefits across a spectrum of disorders. For example, symptoms associated with traumatic brain injury, improvement in concussion symptoms, longevity improvement, improvement with menopause, bodybuilding, treating the symptoms of long COVID, GI problems, addiction, mood disorders like anxiety, depression, even cognitive benefits. Clearly, there's metabolic benefits, but there's also emerging data around cancer benefit and inflammation disorders as well. I mean, at the end of the day, I think the notion that GLP-1 benefits promote things like wellness, longevity, and possess perhaps even anti-aging qualities can all drive outsized demand. And this is really interesting. I just put this to get this slide together just last week ahead of this webinar because we had some sort of hot off the press data that supports this notion. And Lilly published data on their newly launched oral medication called Foundeo, which showed a very robust 16% reduction in cardiovascular events in diabetics who took this medicine. But look at this finding. In this very same trial, there was an astounding 57% reduction in all-cause mortality. So anything that lead to your death was reduced by more than half. There's clearly way more to GLP-1s than just weight loss or cardiovascular benefits. Again, this idea of wellness and longevity, I think, is a fascinating topic that can drive the utilization of these drugs to incredible lengths. But it's not just obesity we're excited about. Let me wrap up in a couple of other hot categories. First of all, cardiovascular disease. We have a host of novel therapies fueling value creation here. And recall, statistically, you're more likely to die from a cardiovascular event than anything else. So therapies here that can reduce or prevent cardiovascular events can be huge mega blockbuster selling drugs. Some of the things that we're following here, for example, are PCSK9s. This is an established druggable target that helps to lower bad cholesterol on top of statin use. What's next is oral formulations that are coming out this year that could be a real game changer in lipid management. And the addressable market here is huge. Again, could be used in combination with GLP-1s. Something we like to call LP little a, well, it doesn't matter what that is, but it's a known independent biomarker for cardiovascular disease. And soon we're going to have drugs to lower it. And with that, hopefully lower substantially your risk of a cardiovascular event. And in stroke prevention, we have next generation inhibitors, which we think are going to be safer and better than the standard of care, which are also mega blockbuster products today. Other things that we're watching in the cardiovascular arena is agents for heart failure, cardiomyopathy, And this is very interesting in hypertension, especially treatment-resistant hypertension. There's a lot of activity going on here. AstraZeneca probably in the lead. But here's another small company called Mineralis. Mineralis is also has an agent similar to AstraZeneca's. AstraZeneca talks about how their drug could be $5 billion or more. Mineralis might have an even better agent in the same class. Their market cap, just over 2 billion. Again, interesting disconnect between the opportunity and value for a small company that has incredible innovation. But each of these categories can really represent a blockbuster potential. And finally, oncology. I mean, I think this has been the hottest area over the past 10 years. Sven and I have talked about this for a long time. Um, but I think people forget oncology. They're sleeping on it a little bit because of all the hype around GLP-1s. And I won't go into detail here just for the sake of time, but the innovation here remains absolutely incredible. And so much so, so many different therapies across these different buckets are moving cancer from chronic disease category to potential cures. And so much so that global sales of oncology medicines we expect to nearly double to nearly four or actually over $400 billion by 2028. So an exciting space, a lot of catalysts, and more to come. So with that, I'm going to pass it back to Sven to discuss the portfolio.
Okay, before I start with that section, I want to offer as well to all the listeners as well to add questions to the Q&A line. We have 5 questions lined up already. It's going to be first come, first serve. So just jot down your questions and we will answer them after this section. So coming to healthcare valuations, and I think this is a really important theme. This is where we feel very, very comfortable for the near to medium term outlook for the trust, because look at here at the column all the way on the right-hand side, discount to the S&P. You see here across the board, all the subsectors trading at very, very meaningful discount to the S&P. And here I would Pharma US ex Lilly 21.9%, Pharma Europe 30.1%. And you will see here we made some move on large cap pharma, and this is partially driven by overhang removed, plus this cheap valuation vis-a-vis the rest of the market. Even like biotech stocks, the profitable biotechnology stocks are very, very reasonable. Managed care and hospitals, huge discounts, but we are a little bit careful there on that group. So really, healthcare valuations really support investing right now inside the healthcare sector. So coming to the next page, and this is really key because we have made some very dramatic changes to the portfolio. See here the yellow box. It shows you a change since the beginning of the year of last year. So huge change for us on exposure in the large cap pharma stocks. Large cap pharma stocks at one point during the fiscal year, they were like 18, 19% of the portfolio, and this compares to the MSCI weight of 50.9%. So we added actually over 1,000 basis points here. We are now 33.8%. So this is actually at the high end of the range where we have been in a very, very, very long time. But key reason behind it is what Trevor outlined, is that the overhang of drug pricing has been removed, and then valuations are pretty cheap. And we like the outlook here on a few names. So we added to our 2 core positions, AstraZeneca and Eli Lilly. We added Bristol Myers, Merck, Pfizer, and Roche, and especially Pfizer and Bristol Myers. They were like some value pickups. Biotechnology, we had a lot of takeouts there. So we had to replace quite a few of the names, but we added in addition to it. So there we added 200 basis points. This is the key to the recipe of the success for the trust. We have always been significantly overweight this innovation-driven subsector. So we are vis-a-vis the benchmark that's 20 points above the benchmark rate. And we have actually even further added to it. So we feel really strong about biotechnology. And I think this will give us the outsized returns vis-a-vis the benchmark. So feel very confident there. Life science tools, we added 300 basis points. This is as well an expansion, a few names added. We added Guardant Health here on to join Natera and Caris on the liquid biopsy side. I think we think this is going to be transformative in the in diagnostics. And we have now 3 names, public names in liquid biopsy there. So medtech, this has been a major mover. You know, I talked about this earlier in the presentation. The medical technology, medtech names like Boston Scientific, Edwards, Intuitive Surgical, and Stryker, they have been core names of the portfolio for quite a while, and they have been very, very important contributors over the past 3 years. Last year, they hit the pause button and, you know, underperformed, in particular Boston Scientific. But we reduced actually our overall exposure there. This is not just stock price, negative stock price returns. We have been actively selling medtech names. So while we are still a bit overweight, instead of being like 2x the benchmark rate in medtech, we are much, much more modest there. And this has been a funding vehicle for adding to our exposure in large cap pharma and in biotechnology and tools. Healthcare services, this is a really challenged sector. It's very cheap, but there's a lot of political pressure there. So we had reduced this year by 340 basis points, but actually in April we did reduce that underweight a little bit by adding to United Healthcare. Japan, small reduction here, and then privates. This is very important. You know, we had 2 exits of our private portfolio. So Caris, a private company which went public last year, moved to the public side, and then Crossover Health was taken out. So we had a significant reduction of our private. So we are 260 basis points there. So we are back into a range where we actually can start thinking about adding when we see great opportunities in the private equity area, that we could add them to the fund again. So if you look at leverage over time, you see here our 5-year average. We ended the fiscal year right at 111, but we had a takeout actually on the last day of the fiscal year, and we sold it right on the day of the announcement. But we are back into here, you know, it's like the 115 to 120 range. You know, as I said before, we feel confident in our sector this year, but we are at the upper end range of our gearing. Really, the most interesting slide is always our core holdings. This is here at the end of March 31st. Actually, subsequent to it, we did two more notable additions. You know, in large cap pharma, we actually bought Novo Nordisk again. So we added as a position that's now a 300 basis point position. So in here you see actually our whole range of large cap pharma holdings, plus Novo Nordisk, which is not shown here since we bought it in April. If you look on the services side, we added United Health here during April. Actually, it was a good add because they had some very, very strong quarterly results here in the first quarter. So our underweight there has been reduced a bit. Now, biotechnology, this is really the engine house of this fund. And you see our largest position in the fund is the M&A basket. This is this collection of small to mid cap biotech names, which are the most likely takeover names. And this gives us really nice exposure to smaller mid cap biotechnology names. And there's been a huge contributor to performance. We've been very, very good at picking up a large part of the takeouts in our sector. But we have made quite a bit of trades as well here on biotechnology. We added quite a few names. So you see here Abivax, hot M&A name. Apellis is actually out of the portfolio now. We added to Structure Therapeutics, to Mineralis. In every single one of these names, what you see listed here, I think there is a fundamental theme. They have a great product, which is the reason why we're in it. But the second leg to the story is always M&A. All of these names are really white hot M&A target names as well. Especially, Trevor mentioned here Structure Therapeutics in the weight loss space, or Mineralis cardiovascular. Xenon, great M&A name. Abivax has been widely rumored, I think, in the press that it could be taken out. GC Oncology is as well one name which is on everyone's M&A shortlist. So this is a super high octane biotechnology portfolio, and feel really strong about this part of the portfolio. With that, I would come to our playbook for 2026. As I've mentioned, our long-term recipe for success being in the most innovative companies any place in the world, with a heavy focus on biopharmaceutical innovation. We hold very, very much true to this long-term secular theme, and feel very comfortable there. I think the second most important theme to the portfolio is M&A. This is a really key theme for the next 3 years. Another important thing what we talked about today is that the political headwinds on drug pricing have subsided, and nevertheless, healthcare trades at a large discount to the S&P. So I think if you put all of this together, I think this gives you a good idea of why we are so bullish and so confident actually in the outlook for the trust into the coming fiscal year and the years thereafter. And with that, we are going to switch to Q&A, and I think we have 12 questions lined up. And let me actually go down one by one. First question is, how long can the biotech index remain divorced from a move higher in 2-year yields? This is a great question. And obviously, higher interest rate, and especially changing interest rate in an unexpected way, can create volatility in unprofitable biotechnology stocks. Typically, the most sensitive sectors to high rates are unprofitable technology companies, unprofitable biotechnology companies. Key thing there is an unexpected major move up, and I think that can create some short-term volatility in biotechnology. That's correct. But the move recently hasn't been anything like what we have seen like in 23, 24. So I think the impact is a little bit less than here. But this is one thing. I think this is one macro theme what we have to look out for, because interest rates can create volatility in biotechnology. So next question is actually 2 questions that I see. They're both on GLP-1s. Trevor, why don't you take question number 2 and question number 3?
Okay. So let's see, do you see any opportunities in complementary drugs to GLP-1s, things designed to reduce side effects, or would these be too small next to the opportunities from GLP-1s themselves? No, this is a really good question. Absolutely, yes, we see opportunities outside of just specific GLP-1s. So there's a couple of categories here that we think of when we think about sort of side effects. One I would call is the tolerability issue with GLP-1s, which are what we call on-target side effects, and that's why it's tolerability. This is the GI discomfort, nausea, sometimes vomiting, a mix of sometimes diarrhea or constipation. Anything to reduce those side effects would be a big win in the space. And one class of molecules that is designed to do such that are the so-called amylin analogs. This is all part of that cardiometabolic pathway. These can be used both alone or in combination with GLP-1s. But from a monotherapy perspective, some of these drugs are placebo-like in terms of their tolerability. In other words, they're almost side effect free. And there's a lot of these in development. Lilly has one, Novo has one, Structure Therapeutics has one, Roche has one, Pfizer has one. So yeah, I think that's a big opportunity as well. The other sort of side effect profile that investors talk about quite a bit is composition of the weight loss that happens. For example, the percent of your body fat that you lose versus the percentage of the muscle mass that you lose. It's never going to be 100-0. That's not how weight loss works, especially if you're an obese person and you lose so much weight. You will lose muscle mass just because you're not carrying around that same amount of weight as you were before. But anything that to help optimize that mix is going to be beneficial. So whether that's adding something like a myostatin inhibitor, which is a potential possibility, or designing a different chemistry within the GLP-1 structure itself that would have differential effects. Like Lilly's retatrutide might be able to do that, which we're hearing sort of anecdotes that it might be much better at reducing fat loss than muscle mass. So yeah, that's absolutely a big part of this going forward. And I think that creates some investment opportunities. The next question specifically on Lilly. Yes, Lilly did sell off quite famously when an HSBC analyst made some very bearish remarks about the market opportunity, and that was difficult, and it created some, as I mentioned, some volatility in share prices of these names, especially during the first quarter of the calendar year, where some of the high growth names were under pressure. We were in a risk off environment, and that was a little bit like yelling fire in a crowded theater. But no, I would wholeheartedly disagree with that. As I sort of articulated, when we were talking about it before, I mean, this market is just for the two incumbent molecules is already annualizing at $80 billion. I think it'll be over 100 billion next year. But just take a step back, and that's what we really like to focus on here. What is this market 5 and 10 years from now? I mean, everyone is fully aware of GLP-1s. It's part of mainstream media. But when we look forward 5 or 10 years and we try to think about the total addressable market, I mean, first of all, if you just try and carve out, people who are obese or overweight, and whether that's a BMI of 30, 33, or as low as 27 with a comorbid condition, that is tens of millions, if not 100 million patients right there. Then you start layering in the other opportunities that we've discussed and that I mentioned in my slides around cardiovascular benefits, and you start to see the total addressable market starting to increase dramatically from just over 100 million patients to approaching 500 million patients. And I think as the data sets continue to unfold and reimbursement gets better, and I know there's some concern about drug pricing, but we see this constantly in biopharma space. That as volumes increase, prices always come down. I don't think the trend is going to be too dissimilar here, other than the volumes could be gigantic, and it'll continue to be so as oral therapies get introduced, combination medicines get introduced, and this is something that Sven and I sort of came up with last year, this idea of creating super medicines, these combinations of medicines that will impact the entire cardiovascular spectrum in other disease states that will drive this market, I think, to an excess of 150 billion and a blue sky scenario of 200 billion, which sounds huge. But as I mentioned as well, oncology is going to be a $400 billion market. So it's not out of bounds for this to be a huge market going forward.
Okay, next question is, what is the impact of artificial intelligence on the trust's portfolio constituents and on the OrbiMed research process? and the healthcare industry in general? This is actually a great question, and I think we addressed it. And actually, Trevor just pulled this one up. This is from our 30-year anniversary presentation. It's like the impact of AI on healthcare, and I think it's going to be profound. It's going to be profound in three major ways. Number one, diagnosis and treatment of patients. I think your relationship with your physician will change over the next coming years. And I think artificial intelligence driven by regular tools like whole body MRI scans or other AI scans will dramatically change the diagnosis. And as well, treatment decisions will be mostly driven by artificial intelligence. Going into the hospital when you go for your surgery will be a profound impact as well, because robotic surgeries will completely replace, I think, the surgeon. And then the most important impact of artificial intelligence is probably the cost impact, because surgery, diagnosis, treatment, that covers 80% of the healthcare costs. And this is where I think AI could really change the cost equation of artificial intelligence. So that's really important. But now, when it comes to day-to-day investing for the Worldwide Healthcare Trust, it is actually much, much less of an impact. And actually, a really interesting thing what biotechnology investors have recently discovered is AI is so disruptive on the traditional tech sector. And create so much volatility on technology. But actually, the impact of AI on biotechnology is very, very modest. Why? Well, AI does not short circuit the traditional drug development process. It still takes 10 years to run the clinical trials. So really, AI is not directly impacting in the near term how the investment returns of biotechnology stocks. And this is actually one thing why there is a bid actually in biotechnology right now, is because tech investors like that aspect, that biotechnology does not get disrupted by AI. And I think this is a really interesting shot in the arm for the biotech sector, that you don't see so much day-to-day volatility from artificial intelligence headlines. Trevor, we have a lot more GLP-1 questions and related questions. Maybe we address them a little bit faster, that we can run through all of the questions. There are a bunch of them and more of them. So next question is GLP-1. What are the potential downsides of taking the drug?
Yeah. So, in the interest of time, first of all, I appreciate all the excitement around GLP-1s because we're with you on that. I would just remind everyone on the call that GLP-1s is a 20-year-old class of drugs. These aren't new drugs. We've just reached a new frontier of efficacy, and with that has come safety. So in terms of like chronic long-term sort of concerns, I don't think there is any. Things around, muscle wastage and cosmetic impact, all of that can be managed with your physician, with dosing and considerations of that. And I mentioned next generation drugs might be even better in terms of preventing some of that muscle wastage. But that is not a concern. That is an on-target side effect that is very manageable.
No, next question is related, but it's actually a really good question. This is on Novo versus Eli Lilly. The question is, which shares do we now prefer? And this is a very timely question since we just recently added to Novo Nordisk. Trevor, maybe you answer that.
Yeah, another great question. So we do own both. I think we're excited about both. Novo suffered from two different things last year. One was pipeline disappointments, in which I think the stock was oversold. But then they had operational disappointments in terms of commercial execution, which I think deserve to be impacting the share price. But now we're into 2026, and there's two things that are different. One, the Wegovy pill launch is very impressive. So we see renewed commercial execution there. Two, the injectable prescription trends for Wegovy are off the bottom, are growing again. And three, we've had massive management turnover across the entire organization. So dare I say it's a little bit of a new company this year, and the valuation is completely detracted from what we think the reality is. But Lilly, we're still very excited about. I mean, they're the leaders in every category, and so we're still very excited about them as well.
Yeah. So next question is, what percent of the portfolio is invested in the M&A basket, and does WW have full exposure to the OrbiMed M&A basket? Yes, 100%. You know, the M&A, we have one OrbiMed M&A basket, and that is 13% of the portfolio. This Worldwide Healthcare Trust has our best M&A ideas inside the fund, and this is exactly the reason why we structured the basket, is that we can make sure that Worldwide Healthcare Trust has our best M&A ideas in there. But as I mentioned before, the other names, you know, are outside the M&A basket, which we have disclosed on the previous page. Those are as well the prime takeout targets as well inside our sector. Next question, really quick. I think you addressed it as well. Do you think Novo Nordisk is worth owning here? I think, Trevor, you answer a question. Yes, we do like it. That's the reason why we just recently bought it. Then another question here, interesting one. Any thoughts, comments about around the ongoing and seemingly escalating offshoring of profits in Ireland by pharma mega caps? Well, it's actually no longer escalating. This is actually on the way out, and this is part of the Trump administration. Trump does not like, you know, pharma companies to have manufacturing in Ireland. This is why he pushed them to have more manufacturing in the United States, because this is where he threatened with tariffs. So I think that trend of offshoring in Ireland is reversing right now. Okay, another GLP-1 question. This is about all the pills coming to the market in around 2030. Do you want to give it a quick go at this one?
Sure. Yes. Yeah. Thank you for this question. I think there's a few assumptions in there that I could help correct. You know, the GLP-1 pills are here now. Yes, there'll be more by 2030, but they're launching now by both Novo and Lilly. And their differentiation, well, the differentiation is that they're oral, not injectables. So that creates a whole new pool of patients who are willing to take a daily pill, who are afraid to take a weekly injectable. So I think that is a bit of a different assumption there. And the other issue about pricing, aggressive pricing by Novo and Lilly, I mean, that is completely reversed since the launch. The list prices to the net prices have come down 50, 60, 70% now. So price is no longer a barrier. And what we've learned with this class of drugs, there is some price elasticity where patients are willing to pay out of pocket, you know, $200-300 a month, maybe not $500 or $1,000, but that's already in the past. So that the prices have come down quite dramatically. So yeah, I think this is going to be a new huge part of GLP-1 market size into the next decade.
Now we are right now here at the full hour. I'm going to answer one final question. I'm going to hand it over to Matt Burrows. So the last and final question is, how do you see growing pace of innovation in China shaping the biotech space, and how is it considered when managing to your portfolio? I think this is another one of these most important secular themes inside our sector. Innovation from China in the biopharmaceutical is irreversible. You know, this is going to be a major force, transformative force inside our sector. This is a reason why we have 10 points of our exposure in Chinese biopharmaceutical companies. You know, these Chinese biopharmaceutical companies have a tremendous cost and speed advantage over their US counterparts. Some of these names, like Jiangsu Hengrui, which is one of the largest names in the portfolio, they have the second largest R&D pipeline in the world. So this is Chinese biopharmaceutical companies, only second to Pfizer in terms of size of the R&D pipeline. This is one of the most important trends. We're quite bullish on that, and this is the reason why we have exposure in the Worldwide Healthcare Trust there. And with that, I would thank everyone for joining the call, and I look forward to possibly seeing you all at the annual meeting in July. And with that, I hand it over to Matt.
Thank you again, Sven and Trevor, for your extremely detailed update. Obviously, a lot going on and a lot to keep you busy. But for those who ask questions, thank you very much for making it very interactive. If you have any further questions, please email ir@frostro.com. A recording and the presentation slides will be sent out afterwards. But again, we look forward to the AGM, which is coming up, and you will receive an invitation in due course. But again, if there are any other questions in the meantime, please let us know. Sven, Trevor, thank you very much, and we'll see you soon.